This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the AJ Bell Money and Markets podcast. I'm Charlene Young.
And I am Danni Hewson. Thanks so much for joining us. We're going to be taking you on a bit of a whistle-stop tour on the latest in the world of markets and personal finance.
Yeah, coming up on today's episode. So the Trump tariff saga takes another twist. Is that so-called taco trade back on the menu? Elon Musk is launching a US political party. Yes, really, just as investors hoped he'd turn his full attention back to Tesla and Starlink.
And he certainly needs to turn his attention to XAI. We'll be talking about Grok as well. Here in the UK, housebuilders have agreed to pay millions towards affordable homes to avoid a decision on whether they broke competition law. And Shell signals weaker profits ahead of its upcoming results. Shein reportedly makes a move to put pressure on UK regulators. And we'll be looking at the mounting pressure on the UK government's finances, from doctor strikes to the OBR's update on the spiralling cost of the state pension triple lock.
Plus, I'll be digging into why more than 500,000 people have been fined by HMRC for not filing tax returns, even though they owed no tax. And later on in the show, we've got two guests. Danni chats with James Flintoft, Head of Investment Solutions at AJ Bell, about how the firm's funds performed in Q2 and what might lie ahead for the rest of 2025. And Tom Sieber joins us from Shares Magazine to talk dividend heroes. Right, let's kick off. That was a long intro. With a sense of deja vu, as we are once again talking about President Trump. So we're recording on Wednesday the 9th, which was supposed to be the latest deadline or pause day. But just as we're sort of taking a breath, the goalposts have moved once again to give a little bit more time for deal making. Is that right, Danni?
They have moved once again. I think it's fair to say that not many of us were surprised, because there were an awful lot of deals that needed to be done in a very short period of time. And when you were just a few days away and you literally had the UK, Vietnam and an agreement with China, I think everyone expected that something would have to give. And what gave, well, was Donald Trump. As you say, the taco trade, Trump always chickens out. This is less a chickening out, I guess, and more an acceptance that maybe his administration had bitten off slightly more than they could chew. It doesn't mean he stopped playing hardball. In fact, although he has officially delayed imposing those higher tariffs on US imports, he has sent letters to 14 countries, including Japan and South Korea, detailing the levies that they face. There will be a 90-day pause, which means that negotiations can continue. We know the EU was trying to get an agreement over the line by this 9th of July deadline. It's now looking like the 1st of August, it says. But this extends the uncertainty, doesn't it? I mean, markets really have been trying to sort of figure out what on earth that they should do next. If tariffs are a negotiating strategy, then it just seems like he's going to cling on to that strategy for, well, potentially his entire presidency, because he doesn't seem to be done introducing new options to the table. Now, in terms of market reaction, I think markets and investors are pretty much exhausted by everything that's going on, and the expectation that what might be true one day might not be true the next. So instead of, that volatile trading that we saw in the wake of those initial tariff announcements, markets have been pretty flat, really, fairly circumspect about how they have responded to this. And I think effectively that is down to the fact that they just don't know what is going to happen next. There have been the reiteration of a 10% threat of tariffs on products from the BRICS group, Brazil, India, and other members. We have been told that talks are going well with the European Union and China, but clearly at the moment there are an awful lot more deals to be done. That promise of 90 deals in 90 days, I think even to the most ardent Trump supporter, that still seemed like an awful lot to do. And I think it's continued to raise questions about what impact it's going to have on the United States. And it's also pushed the goalposts in terms of when investors expect the Federal Reserve will be able to cut rates. We get the latest minutes from the last meeting later today as we record this, which should give us some insight. But I think, insight, it's only as good as the day that it was written.
Yeah, just while we're looking at sort of what's happening as we're recording, I do need to ask you about the copper price, because has that just hit a record high and down to these tariff threats? Is that right?
Yeah, record high. I mean, it had been moving upwards anyway, because I think that there were expectations that Donald Trump would turn his attention to tariffs. But, copper now, it's crucial for things like, EVs, for military hardware, for a lot of consumer grids, just, for the power grid. So the fact that he has now turned his attention to that, and the way he did it, just said, oh, we're going to look at copper now. It just feels like it's a bit off the cuff in many cases. You have to assume that this is well planned out, but certainly the way that it comes out is always surprising and catches people on the hop. And it sort of tends to catch me on the hop when I wake up at 5 o'clock in the morning and suddenly have to talk on the radio about something which has just happened. Today we're doing copper, is what he said. We're going to make it 50%, which is more than I think a lot of people had expected, which is why we have seen first of all, that surge in copper prices, but also we've seen miners looking more subdued, giving back some of their recent gains. Because, the United States does import a huge amount of copper. There is concern now about the supply chains. And it's also more uncertainty. And just to add a bit more to the mix, as well as he's talking about copper, he's also talking about pharmaceuticals and semiconductors, hinted at new levies for both of those industries. And we've seen market reaction today. We've seen shares in the likes of AstraZeneca, GSK, Novo Nordisk, all tumbling in reaction to the fact that he said that potentially those tariffs could go as high as 200%. Now, we know that the likes of AstraZeneca is already moving to produce more drugs in the United States, which is what Donald Trump wants. But these things take time.
Yeah, absolutely. I mean, a lot can happen in a week. Last week, Dan and I were talking about the potential for a bumpy ride because we had this 9th of July deadline coming up. But like you say, maybe markets overall kind of priced a little bit more of this in, but it's still kind of going back to people's personal finances. I think you'll agree, a good message to kind of stay on track and don't make any rash investment decisions. Right, next up, sticking with Trump. He might have fallen out with Elon Musk, but we're still going to keep them together on our show. Danni, how is Elon Musk also keeping us on our toes? Keeping you busy?
Yeah, it's certainly keeping us busy. I mean, I think investors just showed how unhappy they were with Elon Musk's foray into politics, because when he stopped having this scrap with Donald Trump, which we spoke about before on this podcast, when he sort of dialed it back and looked like he was settling in and just going to focus on his many, many businesses, Tesla shares picked up. Now, he decided over the weekend that he is going to launch a new political party. He unveiled his America Party on at the weekend after he sort of said on X, hey, do you think we need a new political party? And I don't quite know how many people responded to that poll were actually US voters. But anyway, he's decided that he is going to do this. And a lot of the attention of this money will go towards people who voted against this big, beautiful bill, or to try and get Republicans who did vote in support of it out when we get the midterms, which are the next set of US elections. Look, Tesla investors want Elon Musk to either turn his attention back to this industry, which has got an awful lot going on at the moment. You know, that the whole sector is struggling. Tesla has seen a second straight drop in quarterly deliveries. There's fierce competition. It's got an aging lineup. There's a lot wrong anyway, without adding this Marmite figure to the mix and adding more political tension. So we know that it's more than 35% that Tesla shares are down since they hit that record high in December after Donald Trump's election, and the expectation that maybe this close relationship would be good for Tesla. But ever since then, you know, we've seen the impact of the tariffs. We know that the spat between Donald Trump and Elon Musk is still simmering away. Both of them have their own mouthpiece from which to, you know, shout all these insults from. And we know that quite a lot of subsidies for green subsidies for Tesla have fallen by the wayside. So I think investors are really worried that he's going to get sucked back in here. They are exhausted. And just to complicate matters further for Elon Musk, just today, we're hearing about an update that he made to his artificial intelligence tool, which was used on the social media platform called Grok. It's an AI tool where you can basically ask this Grok questions. He apparently thought that it was too woke, so said at the weekend that he'd improved it significantly. And then it came up with some pretty anti-Semitic things. I've taken a look at some of the posts that were up there, and they will cause offense to an awful lot of people. And they've now said that they have changed that they're going to take those posts down. But it raises an awful lot of questions about AI, about how it learns, and about our use of it. And it also raises questions about X, because it is still sort of seen as very much a go-to place for a lot of governments, big companies, big organizations to post news updates. And when you have this going along side by side with it, it's deeply uncomfortable.
Yeah, absolutely. Thanks, Danni. Okay, back to the UK now. And 7 house builders have agreed to pay millions and millions towards building affordable homes. What exactly is behind this?
Yeah, so the CMA, the Competition and Markets Authority, were doing an investigation into whether or not these companies broke competition law. And they're not going to actually come back with a ruling on that, because instead they have accepted an offer from 7 of these companies to pay £100 million, which will then go towards affordable homes. So just to give you an idea, the companies that were investigated are Barratt Redrow, Barratt and Redrow, since become Barratt Redrow, Bellway, Berkeley, Bloor Homes, Persimmon, Taylor Wimpey, and Vistry. Now, most of those are posted today saying that this is not an admission of guilt, that they've been working with the regulator. But yeah, clearly it is something which raises an awful lot of questions. I guess it's going to be seen as a bit of a win for the government, because they get some cash. The government's been pushing the CMA to be more pro-growth. So the CMA can say, actually, do you know, it's a win for us because house builders now know exactly the rules in which they are operating, and they've reached this agreement and they've given us some money, and that's all good. And in many ways, it's a win for house builders because it puts this chapter well and truly behind it. And it was interesting to note that shares in house builders on London markets were only down a little bit on this news. But yeah, it does still raise a number of questions about exactly what has been going on.
Absolutely. Another deal, but of a different kind. Sticking with the UK, we've had a quarterly update from Shell, which suggests things have been rather underwhelming, haven't they?
Well, it's released this sort of pre-result statement saying that it expects its second quarter performance to be hit by weaker trading in its, I need to sort of have inverted commas here, core integrated gas division. Now, reaction to that saw its shares down around 3% on Monday. Look, we know that there's been huge volatility in gas prices. A lot of that has been largely driven by what's been going on with geopolitics around the world. It's also been a pretty mild winter. And I think second quarter earnings right across European oil and gas sector are expected to fall because, they've only been partially offset by higher refining margins. We've seen oil prices down as well, despite that sort of mini blip where we saw them tick up after what was going on in the Middle East. But they have remained fairly low. And all of that, of course, impacts on profitability. Before we move on away from market news, I should just fill you in a little bit on Shein, China's fast fashion retailer. We know that it's been trying to get an IPO over the line in the UK. There was a lot of rumblings the last couple of days because the Financial Times reported that it is filing for an IPO in Hong Kong in order to accelerate, to put pressure on the regulatory listings commission over here in the UK. We haven't had any update from any of those parties, including the Financial Conduct Authority. We know that China's regulators have really tightened up control about how these IPOs are done in foreign countries. But it does feel like the potential of Shein listing in the UK is sort of falling away a little bit.
Yeah, meanwhile, I swear I'm the only person in the UK who's never bought anything from Shein, but it's not.
Don't have teenage girls, Charlene.
No,
That's what it
true.
is.
That is true. So from underwhelming to full-on stark warning from the Office for Budget Responsibility on the risk to UK public finances. We saw this issued yesterday, Tuesday, exactly 1 week before the Chancellor will give her Mansion House speech. Now, I think we all heard about the recent U-turns, but failures to cut spending, along with soaring national debt, again has resulted in, and I will quote the words of the OBR here, a substantial erosion of the UK's capacity to respond to future shocks and growing pressures on the public finances. Now, this, if you've seen any of the headlines, has clearly fueled more rumours of tax rises or perhaps an extension to frozen thresholds at the next budget. That's likely to be October or November. We don't have the date just yet. Perhaps that will come Tuesday next week. On the pensions front, the cost of maintaining the state pension triple lock is kind of an alarming thing to pick out from those risk figures. It's now forecast to be 3 times the government's original estimate by the end of this parliament. So to put some figures on that, £15.5 billion a year rather than the £5 billion a year that was forecast. And the state pension is on course to cost 7.5% of the UK's entire GDP within 50 years. It was 2% back in the 50s, and now it's running currently at 5%. So I don't think huge surprises in terms of the overall theme of the OBR risk report. But I think when you see some of those figures kind of laid bare, there's still, a huge degree of alarm and obviously a huge degree of pressure on the Chancellor and the government as to where they're going to turn next. And I don't know if you sort of saw any other key takeaways, Danni, any reaction that was surprising or not?
Markets didn't really react.
Yeah.
Honestly, I think at the moment, most of it is pretty much priced in. The Chancellor, Rachel Reeves herself, is now not ruling out tax rises of some form or another. She's not explicitly saying that it's happening, but she's also not saying absolutely no way. We've seen these U-turns from the Labour Party in terms of a number of the measures that she'd wanted to take in order to try and bolster the finances. One of the numbers which really struck me was the OBR seeing total debt above 270% of GDP by the early 2070s. I mean, we're at 96.5%, but 270%. I mean, that is unsustainable. It was interesting that just looking at the 10-year gilts, they didn't move very much, and they have sort of backed off again today. I think really the expectation is that in this next budget, Rachel Reeves is going to have to, really deliver some unpalatable home truths. And there will be something, either spending will have to be cut. She's been told by the money markets that, borrowing more is not an option because then it's merely going to cost more. And tax rises, she's really sort of locked herself in terms of manifesto promises. But I think most people now widely expect that those frozen tax thresholds are going to be extended, and some other measures are going to have to at least be discussed in order to, really look at things going forward.
Thanks, Danni. And whilst we're talking taxes, I just wanted to highlight a story I've seen this week, which was an update to some annual tax return statistics. It's been reported that HMRC has now issued fines to over 600,000 people who owe them no tax at all. And that's going back over the last 5 years, which is just bonkers, really. Yeah, it all comes down to the automatic penalties that are issued if you are either late with your tax return or if you do owe tax, the penalties on what you owe. But here we're talking about people who owe no tax at all, but HMRC was expecting some kind of return from them. And it is also down to HMRC not proactively removing people from the self-assessment system, which is something, it does want to do. It's all part of trying to simplify the maze that we're currently kind of faced with. Now, if the taxman thinks you should be sending them a return, even one with £0 tax bill on it, they are going to issue you with a £100 fine automatically if you do not file one on time. Now, the main deadline that most of us are familiar with is that 31st of January for online returns after the end of the tax year in question. Now, this 600,000 number spans back from 2018 to 2023, the kind of most recent data, and includes some people who've been issued with fines multiple times. So if you think about it, 600,000 fines at £100 each is potentially adding up to many millions of pounds. But, it really does raise questions about this continued push by HMRC towards digital, whether that's continued push to making tax digital or answering queries online rather than picking up the phone. But this isn't people dodging tax. This group of people do not owe anything at all, and multiple fines also suggest to me that there must be some vulnerable people included in that list, and those efforts to take people out of the tax system who don't owe anything are clearly not really working. Now, if you think you no longer need to file, if you've had to file in the past or you've received a demand and you think it's just not applicable to you anymore, then please do sort of tell HMRC in the tax year rather than risking a fine. And if you have forgotten or you just really didn't realise you had to file and you've received a fine but you've got no tax liability, do appeal this, because this is one area where people can appeal and often it does turn out successfully. And whilst we're talking tax, actually just a very quick reminder for people who did file for the last year and had a tax bill in January, we're fast approaching the deadline for second payment on account on the 31st of July. So check in online, look at your HMRC app just to check that you might have something to pay, and obviously that you've got the cash ready to go if you're like me and you like to leave it till the very last minute to pay it across.
I've been a good girl. I've already paid.
Oh, you're getting. Yeah, my husband's very good as well. And I sort of look at him, but yeah, you're not going to risk a fine, are you? So
I
no,
just want it out the way.
no, I totally understand that. It's better to pay it than miss it, of course. No, enough about HMRC playing the potential villain. We've got Tom Sieber back on, and he's going to run through a topic the shares team have zoned in on this week. I gather, talking villains, this is investment trust dividend heroes. Tom, can you tell us a little bit more, please?
Yes, thanks for having me, guys. We're talking about dividend heroes, and unsurprisingly, that's a popular marketing tool for the investment trusts which qualify. But it is also a sort of meaningful achievement to be on this list. So it refers to a group of trusts which have increased their dividends every single year for at least 2 decades. So fairly heroic, I guess. And appropriately enough, there are 20 trusts which qualify out of a total universe of several hundred. So it is quite a select group. And some of these trusts have increased their dividends for much longer than just 20 years. So there are 4 names: City of London, Alliance Witan, Bankers, and Caledonia Investments, which have increased their dividends every year for the last 58 years. So to put that into a bit of context, and I guess to reach for quite a popular milestone, that's ever since the England men's team last won a major tournament in football. So when Bobby Moore and co were lifting the World Cup on home turf. So a really, really long period of time over which they've consistently increased the dividend. And actually, half of the trusts in this dividend heroes category have increased their dividends for at least 5 decades. So there's quite a number that have a very, very long track record of increasing their dividends. There's also a list that the AIC puts together of next generation dividend heroes. So these are trusts which have increased the annual dividend for at least a decade, but less than 20 years. So less than 20 years needs to qualify for being a fully fledged dividend hero. And as you say, the shares team has been looking at this. So in the article in this week's magazine, we profile some of these trusts, look at the sort of different ways they generate a consistent income, and also which of these trusts have increased their dividends to the largest degree. Because I guess, nominal increases in the dividend every year are nice, but if they're behind the rate of inflation, then in real terms, they're maybe not that meaningful. So it's interesting to look at that aspect of things too. I guess, like I said, it's a popular marketing tool, but it is a meaningful thing for a trust to be on this list. And a broader point to make with investment trusts is it's partly down to their structure. That's something that really helps them to sustain dividends over time, because they have the ability to hold back income they receive in kind of bumpy years as reserves, which they can put towards future dividends. And clearly that's a real advantage, and one that was particularly in evidence during COVID, when you saw many kind of companies that these trusts would have been invested in suspending, cutting or even cancelling their payouts. So there is a sort of an advantage that allows investment trusts to keep increasing the money that they dole out every year over a very long period of time.
Yeah, no, I was going to ask, to kind of going back to basics on that, and why, investment trusts do kind of either market this or feature heavily in the list, as you said. But I think it's handy as well, like you say, that the shares team have looked at how that's kind of progressed against inflation as well, because like you say, it's all very well kind of holding back some of that, but if people aren't getting the benefit of that real growth as well. So yeah, if it's investment trusts are kind of new to you, or you want to kind of hear a bit more, we also do have a monthly spin-off extra episode of the investment trust podcast, if that's something you would like to learn a little bit more on.
Thanks so much, Tom, for coming on the show. I'm sure we'll talk to you again soon. Now, our interview this week. I sat down with James Flintoft on Independence Day, July the 4th. I'm dating it because obviously things move on so quickly, as you will hear from this interview. James is the head of investment solutions at AJ Bell, and I asked him to review how the AJ Bell range of funds performed in the second quarter of 2025. Let's listen to what he had to say and what he thinks might drive performance for the rest of the year. James, thanks for joining us on the Money and Markets podcast. I want to focus primarily on the second quarter, looking back, because I'm hyper aware at the moment, whenever we record this stuff, events just keep fast forwarding. So we may well be talking about something which has already changed. So let's jump in with tariffs. Obviously, still at the forefront of everybody's mind. And again, things are changing all the time. But markets have recovered spectacularly after April's collapse.
Yeah, the markets are saying the worst is over here, in effect, that we've got nothing to worry about. As we know, when we're recording this, we're just on the edge of the pause in tariffs, so we'll see what happens in the next couple of weeks and how the market responds to whatever goes on there. Maybe Trump will be in a better mood after the tax bill has got through Congress, so we'll see. I think there's a lot to digest in terms of what has happened in that one quarter. It has been, the word's uncertainty still, isn't it, around what policy making is like in the US, and particularly how that's impacting the economy. I think it's fair to say that there's been an impact, right? There's been business uncertainty caused by this. There were IPOs, M&A put on pause in the US. That does have a knock-on impact on the real economy. But we're struggling to see it in the data at the minute because it's so noisy. If you look at some of the sentiment data, it's up and down. So it is very difficult to determine. And the other part of the equation is inflation, obviously. Tariffs feel inflationary, but we're not seeing it quite in the data yet. US inflation's made real progress over the last couple of months. It's still ahead of target, but it does feel like there should be some impact on inflation should tariffs kind of come back to the fore in the second half of the year. Noisy
is a good word. I want to focus on some sector-specific stuff because when we spoke before, there had been sort of a bit of a fear that the AI bubble would burst. We're just at a point where we're seeing Nvidia, almost making that record market cap, but for a breath, may have happened by the time this goes out. And defence stocks too doing well.
Yeah, the narrative has returned, hasn't it, I suppose, in terms of AI. I think there's a greater appreciation around actually that there's going to be innovation across the world and China's going to compete in this space. But yeah, they've come back really strongly. Which in some ways has been a surprise. Maybe that's people thinking actually there will be a bit of shelter there from maybe any economic headwinds that come from the tariffs, and maybe more cyclical businesses will be the ones that struggle from this, not those kind of cash-rich, magnificent 7 or 8 or 9 as we now call it, I suppose. And then I guess in terms of the other narratives in markets at the minute, the strong one's been in Europe around defence, hasn't it, and spending there. That continues to roll as a theme, seems to have legs in terms of the policy change there. It seems genuine that they're willing to press on with that, and that's broadened in terms of its impact on markets. We've seen some benefits of that in the UK. Obviously, the commitment to spending more at NATO recently has been a real positive theme for some of these kind of unloved markets in a way. But we shouldn't forget that. Although some of those markets are said to be unloved, actually, they produced pretty good returns last year. So it's been a decent time to be invested globally and not outside of the US. It's just the US last year did so well. And now it's really coming to the fore, the stories that are available elsewhere.
I also wanted to ask you about bond markets. It seemed like years where we just didn't really talk about bond markets, and yet over the past few years it's in many ways been the more interesting stories than equities.
Yeah, in some ways, isn't it? And it's very difficult for bond markets because the inflation backdrop is so uncertain. Like I said, there's been progress, less so in the UK, and we think there's some vulnerabilities in the UK. We're seeing inflation above 3% and it's expected to be there for the rest of the year. That poses a challenge for the Bank of England in terms of how they respond to any economic weakness, and the numbers aren't looking great at the minute. So I think there's probably for the bond market, it's a bit of a challenging time. And for us, we've been thinking about, are we being compensated for taking this risk, particularly around inflation, but are we being compensated for taking other risks in the bond market? Debt levels continue to rise across the UK and US. Are they factors into prices at the minute? We feel that actually we're much better off in shorter dated bonds rather than longer dated ones, because you're getting a similar level of yield, but you take less risk. So we've been quite defensive, I suppose, in our approach to bond markets.
So let's then drill into the AJ Bell funds. How have they performed over the second 3 months of the year?
Yeah, performance has been good, despite all that's been going on. And particularly for the higher risk funds, they've performed well. Diversification as a theme has come to the fore this year, and we try to make sure that those funds are diversified at all times. Particularly some of the performances that we're seeing in emerging markets like Korea and Taiwan, particularly in the second quarter, they've helped those funds. Lower down the risk spectrum, a little bit of disappointment, I suppose, in terms of the returns there, that they've been a little bit shy on a longer term basis of what you'd expect from bond markets and cash rates being above 4% there, because we've had some headwinds in terms of the recent weakness in the US dollar for those portfolios.
You made changes in the portfolios back in January. You've obviously kept tabs on those changes. Have they done what you wanted them to do?
Yeah, it's a short time since we made those changes, and we're long-term investors, so we're trying not to interpret what's going on with too much confidence, I suppose. We've done well in terms of reallocating to Europe. That's been timely. That does come back to the framework that we use to invest, which is valuation based, and at the start of the year it was telling us that Europe was cheaper relative to other markets and that we should be allocating more to it. We did so, and then it's come off for us, I suppose, in a way, in short order. I think probably over the long term is our focus, and that's really why we've reallocated there, and we think there's better returns to be had globally than just being in one single market. That's it.
I know I always ask you to get your crystal ball out and give it a wipe off, and considering the volatility that we've had, the uncertainty, it is incredibly hard for you to sort of take a guess about what might come through the rest of 2025. But is there anything in particular you're looking at?
I suppose the tariff situation is front and centre, isn't it, really? And any economic weakness and evidence that we can see in the data going ahead, I feel like Q3 is going to be pivotal there. We'll start to be able to see maybe in inflation what the impact has been, maybe in terms of the supply chain disruption potentially coming to the fore. It's impossible to predict what's going to happen for the rest of the year, and I think just this last quarter gives us just a bit of a kind of a small example of what can happen. Is that lots can happen in a quarter, but actually markets just muddle through, and that happens more often than you think. It doesn't make for a very exciting headlines, but actually markets tend to do okay over the long term, and that's our focus really.
James, thanks so much for talking to us.
Thank you.
That's all for this week's episode of the AJ Bell Money and Markets podcast. Thank you for joining us.
And don't forget to like and subscribe so you never miss an episode. And if you enjoyed the show, also feel free to leave us a review.
Thanks for listening. We'll be back next week with more insights and analysis. And just to let you know, that will mark 2 more episodes before our little cheeky summer break as well. So thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.